Hi everyone. So today we are going to be doing another video on the investor profile series that Dom and I do. This is going to be on Bruce Flatt, who is the current CEO of Brookfield Corporation, a stock that we just covered. Dom is going to go ahead and talk about his background and then the performance. Then I will discuss his investment philosophy and then Brookfield's current holdings. So Dom, whenever you're ready.
Can you see my screen?
Yeah, perfect.
Wonderful. All right, so let's just dive right into it and go right into his background.
Okay.
So Bruce Flatt was born in 1965 in Winnipeg, which is the capital of the Canadian province of Manitoba. And it says it shares the border with the U.S. states North Dakota and Minnesota. So just think kind of like the upper middle of the U.S. essentially. He graduated summa cum laude in 1985 from the University of Manitoba. He was trained as an accountant at Clarkson Gordon, which is apparently later acquired by Ernst& Young, before joining EdPer, which was like the precursor to Brookfield. It was the original name. In 1989 as CFO of EdPer's financial hub Hees. So then a few years go by. And in 2002, he took on as CEO of EdPer and it controlled the publicly listed Braskin. Later changed the name to Brookfield in 2005, and then since then he's hardly diversified its portfolio, and it says it's non-core, cynical or
Cyclical, yeah.
clinical holdings. No, my bad. I can't read sometimes, and there's a lot of words.
Uh,
And centered around the company around asset management, real estate, renewable power, infrastructure, and private equity. And we'll kind of see this a little bit later as we kind of go more into how his
okay.
strategy evolved over time. And it says Brookfields currently has AUM in excess of 500 billion, and over the last 20 years achieved a CAGR of 17 cent per annum versus 6% for the S&P 500 over the same period. Pretty impressive there. All right, so now we're going to take a little bit of a change into kind of like his ideals and like his way of doing things for investing and how he likes to do it. So it says that soon after he became CEO of Brazen, he forced board members to hold a minimum amount of equity and increase holding periods of options issued to staff. And it says by 2012, Bruce wrote that senior management is committed to align our interests with yours by holding the vast majority of our individual net worth in Brookfield equity. I think that's pretty interesting just because, being on the board, there really isn't like, for most places, not like a true requirement to be like super invested in a company per se. And so by making the board members have to hold some type of minimum equity in the company, it does, like he said, like it does force them to have like greater care of the stock and making sure it does well because they're literally now invested to a significant amount, whatever that amount ends up being. So it's just something interesting I thought from his point of view of being a CEO of how to make sure the board actually does things that are helping the company.
All right.
And it says that Bruce increased transparency by emphasizing key metrics. He's quoted as saying, "We have two principal financial performance metrics, operating cash flow and total return, both measured on a per share basis. We define total return as the change in underlying value together with distributions to shareholders." So again, just reinforcing that shareholder value and making sure that shareholders are getting rewarded for their investment is part of their goal, essentially. And then it kind of actually stretches this further by saying, "You communicate Brookfield investment goals clearly to shareholders. Our goals to invest capital for clients and opportunities which have reasonable returns in a downside scenario, 68% on equity, have the potential to generate good returns on most scenarios, 12 to 15%, and in upside cases generate excellent returns at 20% plus." So he's definitely in it trying to make everyone some money. It's definitely his goal, even if it's only a little bit. 68% is not terrible, but if 20 plus is like you're doing pretty well. So it's good to hear that he
Yeah.
is really investor focused. You have something to add, Matt, or no?
No, 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 no. I was saying that, yeah, his returns are incredible. And, I'm glad that he always tries to have good expectations, I would say.
Oh,
Reasonable
absolutely.
expectations. Yeah.
All right, moving on. So as we've seen with other investor portfolios, we've kind of seen value investing as kind of like I don't want to say it's like the new thing, but at the time when people were, I guess, just investing, just in companies that were doing well
Right.
generally, it seemed like that was more or less like the trend. And so him and other pioneers we've kind of already looked at really worked on value investing. So essentially trying to get stocks and assets at a discount. By getting them at a discount, it helps build a margin of safety into acquisitions, which is kind of what his big thing is, like we talked about earlier, because he has a lot of like real assets, and so making sure you can get companies on the cheap, whether they're heavy in debt or whatever, is definitely part of the strategy because they might have a lot of other things like real estate or equipment that can counteract the debt, and then in the end maybe turn a big profit if they can turn around the company. And so value investing is definitely where his mindset is in terms of how to execute on his strategy. It goes on to say that some examples of what he did for this were buying a building in 2002, which is quote a 1.2 million dollar, or excuse me, 1.2 million square foot divided interest in the three World Financial Center, which is which he got at a substantial discount to replacement value due to hangover of fear from the 2001 September 11 2000 attacks. Which again, that's not too surprising considering like you have a giant building get destroyed by terrorists. You don't know if other giant buildings will be targets. So obviously, people are less likely to put their money into that, whether for any type of investment. And so he saw that as an opportunity to get those places at a discount, and in the end, ended up paying off for him. And so it says right here for more investments that he did, it says having maintained a strong balance sheet, Brookfield went on a shopping spree for $4.1 billion of equity investment during the 2008 and 2009, which, as many of you know, is the financial crisis across the world, but definitely in the United States. It says many of these investments were made through the purchase of debt for conversion to equity, benefiting over leveraged capital structures. Not surprising considering lots of places were in debt because they took out large mortgages they actually couldn't afford. So obviously, got to pay those back with the assets that you were going to cover them with. So good play on his part, seeing that at the time. And it says during the sovereign debt crisis, he bought various distressed real estate infrastructure investments, as I was just mentioning, in Europe. And in 2015, they were able to purchase assets in Brazil that, quote, they would never otherwise been able to, excuse me, that would never otherwise have been available with pricing at fractions of replacement cost that discounted almost every negative scenario. So in the end, even just doing that, he was going to make out just because of the materials and stuff from those assets in Brazil. So definitely a smart guy and sees when something's a good play. Excuse me. It says recently Brookfield has been able to utilize its competitive advantages of size and operating expertise to continue to find value in more expensive markets. And so acquiring a number of businesses that have inherent defensive protections. These include a long-term contracted natural gas gathering and processing business for 3.3 billion in Canada, as well as 11.4 billion portfolio of largely office and residential properties in four premier markets in the U.S. that are acquired with few competitors due to size and diversity of assets. It does kind of want to basically mention that like um, having larger assets to invest into that aren't always just like strictly on the value play can be helpful because stuff with real assets have a really good chance of continuously growing. And so even if you do get it at like the market rate ish, then it's not as bad because if you know the growth is really going to be there for it, it's worth getting in just early, whether it's a great price or an okay price, is essentially kind of how part of it goes with the real estate and other physical assets when he was buying them up. So I'll shift over to core principles. So he does have a few core principles, but then there's also strategies we'll talk about for how he invests. So he's quoted as saying, over time, we have found that the five most important principles to successful real asset investing are to stick to what we know, ensure that we are diversified, buy at a discount to replacement costs, focus on quality assets in business, and finance with asset-specific non-recourse debt. So I feel like this is pretty standard. I feel like for most people, or at least they're good as it says, principles to follow. You never want to overpay for stuff. You always make sure you understand what you're getting into. Things like that. It's nothing too crazy, I would say, for most people to understand. And so let's take a little detour and go and look at the strategies they use to reduce risk. So they, number one, say long-term leases, an average length of 10 to 20 years, provide visibility to cash flow. So obviously this is for like real estate, if you're like buying offices or whatever, making sure you have long-term leases. Balance sheet strength and high levels of liquidity allow Brookfield to withstand adverse dynamic circumstances to implement value investing strategy. Matching debt to asset characteristics. Often long-term leases are matched to long-term fixed debt. Debt expiration. Debt matures and diversified over extended periods of time, with only 10 to 20% being renewed annually. Non-recourse debt is recourse to the asset, not to the corporation. Making use of diversified funding based, including fundraising, preferred securities. Interest rates strategy, locking low interest rate terms when available. So I feel like everybody tries to do that, so that should be, I feel like, number one. Currency risk is often hedged to US dollar. Transactional approach to emerging markets: sell assets once they reach intrinsic value rather than hold on for longer in emerging markets to protect from future uncertainty. Cutting losses short. Some businesses, no matter how deep the discount or replacement costs, are just bad business. So sometimes, it's too good to be true. It's because it's too good to be true. So always keep one eye open when you see something that just looks too good. Avoid participating in structured financial assets. And then finally, being prudent in the face of development and approval risks. So those are the strategies he follows with his principles, and we're just going to go over a couple more things about him and kind of transition over to how the actual uh, company has been doing. So as I mentioned before, they do a lot of real estate and real asset type stuff. So the article mentions infrastructure as well as real estate and private equity. Each becomes more attractive as investments get larger. The competition for larger acquisitions is less, and the sophistication required to operate the assets increases because of their complexity, therefore favoring large and experienced managers. This is kind of what I was talking about before, where they do have that strategy of getting some type of bigger players when they invest in them, not because necessarily they're bigger, but because they have the expertise and they have the potential to grow because of those assets and the teams that work behind them and the knowledge that they have essentially that it makes it worth it in the end. And it basically goes on to say, lastly, the larger assets acquired are generally also higher quality. Kind of I was talking about that experience. They often have better counterparties and strong management teams. As a result, we believe that our infrastructure business can scale to many times the size it is today. All right, and we'll look at the Brookfield structure. So essentially, early on, it says that Bruce realized the inherent potential of real assets to be attractive to a wider investor base. So he's aimed to establish Brookfield as an asset manager of choice for institutions and other investors. Then he says they expect that over the next 10 years, most institutions will increase their allocations to real assets between 25 and 40%. Bruce reorganized Brookfield's holding structure, grouping activities into key businesses, and then listed each of these as listed partnerships both on the Toronto and New York stock exchanges. And then it says here that the Brookfield Asset Management sits on top of managing and owning part of the share of four capital partnerships, which is basically property partners, infrastructure partners, renewable partners, and then business partners. And then it says, further to list of the partnerships, Brookfield also offers investors private funds and public securities. Total assets under management were in excess of 600 billion as of 2021. Neuberger's, Berman's, Charles Cantor cites that through the listing of its partnerships from Brookfield's significant contribution to its investment funds, Bruce created a brilliant structure of lifelong entities with essentially permanent capital. So as you can see, the physical assets and the way that that's been kind of helping out is been extremely helpful and beneficial for Brookfield in the long run, just because of all the acquisitions and how kind of the real assets have matured and gotten them more money over time than maybe something like a non-real asset, like some type of software company or something like that. All right. Finally, last thing I want to mention about their company is they acquired a company called Oaktree. So in March 2019, Brookfield announced its takeover of Oaktree. The acquisition allows Brookfield to offer a larger range of credit strategies. Simultaneously, it represents the joining of forces of two titans in the value investing world. Howard Marks explained that Brookfield's offerings mesh with Oaktree's without significant overlap and cannibalization, with the same reputation, the same growth record, and the same culture. Furthermore, Oaktree is known for being able to wring returns during sluggish periods, which isn't right for them. When it isn't right for them. And then it says Brookfield to grow. Oaktree is hard to, is a hard Oaktree is a hard to replicate business that have taken a long, long time for Brookfield to build ourselves in one era that we were lacking. The acquisition of Oaktree was financed with 2.4 billion of cash and issuing of 53 million Brookfield shares. Bruce expected to create value in excess of 11% FCF yield, and otherwise would have been returned to shareholders. Bruce has remained Bruce Bruce's Bruce's remains focused. I think that apostrophe S is a spelling error. Bruce remains focused as ever to generate increased cash flows on a per share basis, and as a result, higher intrinsic value per share over the long term. Which, as we saw before, he said that is typically what you're trying to do is hit a certain intrinsic value before you decide to sell a stock or a company, depending on what the goal of it is. And so that's kind of it. Kind of gives an overview of what his investing strategy, his early life, how he transformed the company, changed it up to where it is today. We did want to mention one thing prior to doing the company numbers is we kind of want to talk about one really quick connection between him and a person we did before, Bill Ackman. So normally we try to find an article, but we couldn't find one that summarized all of the points we wanted to talk about nicely. So in this case, we used Gemini, and so we just kind of double checked all the articles that it took its information from, and they're all pretty much what we're looking for. But again, we just couldn't find it that talked about it in a concise way, which is why we kind of chose to use Gemini for this part and the next part. But follow along with me. Basically, Bill Ackman and Bruce Flatt met in 2010 while collaborating on restructuring of General Growth Properties (GGP), as we talked about, which is a bankrupt shopping mall operator. We did talk about how kind of his original company. They kind of talk about it here. Pershing Square, essentially, was one of his earlier hedge funds that did pretty well in the end. But basically, they worked together during the financial crisis, kind of gave them some tips, strategic stuff. It says right here, Brookfield, led by Bruce Flatt, was brought in as a strategic partner when the company needed significant capital infusion. So gave him some tips, gave him some capital. He did pretty well. And it says that the legacy of the GGP deal became one of Pershing Square's most lucrative investments, turning a $60 million stake into roughly 1.6 billion. Pretty good. And then it says the foundation of mutual respect eventually led Ackman to build a multi-billion-dollar stake in Brookfield Corporation in 2024, making it one of his largest holdings. So in the end, he ended up giving back in a way. Bill did to Bruce by investing in Brookfield by giving quite a bit of money. So just an interesting little connection I wanted to talk about there. All right. So kind of like I mentioned before, we couldn't find an article that talked about all the information for the company performance. So we had Gemini do it, but again, we did look at the sources just to confirm that numbers were accurate. But this kind of just gives it a much more concise look at it. Okay, so the Brookfield Corporation under Bruce Flatt achieved a 19% annualized total return for shareholders of the past 30 years. 30-year performance is $1 million invested in Brookfield 30 years ago. We're worth approximately $285 million today. Pretty crazy. Long-term consistency, it says Flatt has consistently delivered on these returns with a track record of roughly 21 years of 20% annual returns during his 10 years CEO. Very impressive. During 2024 through 2025, it says in 2024, Brookfield's share price increased by 55%, while its intrinsic value grew by 19%. In 2025, the stock generated a 21% return, outperforming the S&P 500. But then finally, it says for future outlook, Flatt has expressed confidence in maintaining 15 plus minus returns over the next 20 years. Again, very impressive. Can't complain there. So now I'll transition over to Matt, and he'll kind of take a deeper dive into them, talk about their stocks they're invested in, things like that, and we'll see how that's going.
Okay, thank you, Dom. All right, so we're going to first go ahead and we're going to speak about his investment philosophy, what he generally looks for. And unfortunately, there aren't really any websites, but thankfully we have Grok and we have Claude too to break it down. But more importantly, like Dom mentioned, is that he has just basic value investing and intrinsic value focus. Obviously, that's very good to find undervalued opportunities. Especially in this market, to have good long-term value in these investments as well. A contrarian approach, a preference for tangible real assets, like Dom said, infrastructure, real estate, renewable power, and other durable essential properties. These provide inflation protection, stability, and intrinsic value tied to physical components, often benefiting from megatrends like digitalization, energy transition, and deglobalization. We also have long-term holding and compounding. Again, that's self-explanatory. You have downside protection as priority. Of course, we mentioned that as well, to always be very careful. And also, just something more important people don't think about is just patient capital, opportunistic discipline. So of course you have to wait until the number is correct and you're getting something for cheap. Of course, that makes sense. And he more or less emphasizes that philosophy. So a lot of the things too, and I wanted to go down here a little bit, is I wanted to get a couple of examples of what he was actually doing in these investments. So, or his returns for them. So for example, in 2018, he acquired Westinghouse Electric for $4.6 billion. And they acquired Brookfield, or I'll just say Flatt, acquired it out of bankruptcy, Westinghouse, and executed a successful turnaround, operational improvement, costs added on M&A. And then the Westinghouse Electric investment actually had a six-fold return. You could see it was a six-fold return on the initial investment in the private equity side while retaining control via Brookfield Renewable, which is again another aspect, or we're going to get to it in a second, but it's another holding of Brookfield Corporation. They're one of the largest holdings in the world. So really good to say, really good to see in general, I would say. And the later developments of it are, which is I think even more interesting. So the U.S. government is going to partner with Westinghouse Electric for $80 billion in new reactors. And that's going to be even further upside. So we're looking at even a higher multiple because now it's going to be worth around $30 to $50 billion today. So absolutely incredible. She was smart for doing it, honestly brilliant for doing it. But that's just another great example. General growth properties, Dom mentioned. Oak Tree, capital management, Dom also mentioned. So we won't talk about that. But we could also look into, for example, Duke Energy. He bought it for 2025. So we'll get to see what really happens in, let's say, 10 years from now or something like that. But he bought in 2025, 8.2 billion enterprise value for 20% stake, $6 billion worth of equity. So it's very recent. We're gonna see what it returns, but it's an infrastructure play that's gonna probably give mid-teens estimated growth, and we'll see if it pans out. But just to have an idea of what transactions they're doing more recently is always important. Now, when we take a look also at what Anthropic is saying, because I always like to compare and contrast of the different AI companies of what they're thinking. So again, it's the same things more or less, so the same core principles. So you have real assets as the foundation, long-term capital deployment. So it's the same thing, buying at scale. And again, they have this idea, which is, I think, very important to emphasize, and we covered it in the video too, the 3-engine compounding model. So you have three things: insurance, the assets under management fee, and then you have capital appreciation or carried interest as well. So it's just very important to keep reminding yourself that, or reminding everyone that that's how Flatt usually is compounding the money, and it's good to see. And also another thing as well is scale as a moat. So he is thinking that he could be like Berkshire Hathaway, except for private companies. And that's exactly what he's more or less trying to create here. And right here it says it too. He explicitly believes size is a competitive advantage in alternatives. Alternative meaning like alternative investment managers like KKR, including Brookfield as well. Brookfield can underwrite $5 to $10 billion single asset deals that only a handful of firms globally can compete for. This reduces competition, improves pricing, and creates better risk-adjusted returns. And again, exactly. Buy irreplaceable assets at a discount to intrinsic value, improve them operationally, hold them patiently, and let the compounding of real cash flows do the work. So pretty much exactly what Buffett doing, like I said, except for real assets in private markets. Now, I thought I would just add this in because I thought it was pretty curious. So this actually popped up on YouTube recommendations, and this is Bruce Flatt. He's doing a investor presentation, and we're not going to cover investment. We already covered it, but just to get an idea of his strategic vision, because I did ask AI or Gemini what it is in this video, and he says that Flatt intends to scale the insurance business significantly, projecting growth from roughly 26 billion in capital today to over 600 billion in assets. Just to let people know, because he's obsessed with insurance. Insurance provides float for him to invest in other assets, other private markets, other private equities, other public equities as well. He also believes that capitalizing on AI infrastructure, he believes the need for power grids to double globally to support artificial intelligence in one of the most significant investment opportunities in 50 years. Real estate recovery, he thinks interest rates will decline, real estate will go up, so part of the cycle too. And he thinks that overall that Brookfield could maybe not provide the 19%, 20% returns as they once were, because they're much larger, but 15% annualized returns, which is still incredible, especially at their size. So really good to see for them. Now, lastly, the investment portfolio, or what his current holdings are, more specifically. So you could look this up on Whale Wisdom, is one of the companies, but I think Anthropic has a better breakdown. And they have a $60 billion public portfolio, Brookfield. And they own, we covered this in the other video, Dom and I, but they own about 73% of BAM, which is Brookfield Asset Management, 69% directly, 4% through Brookfield Wealth Solutions. This is the fee-earning asset management platform, so keep in mind it's assets under management. Now, another portion they own 48% of Brookfield Renewable, one of the world's largest publicly traded renewable power platforms. And we mentioned it before, they're into solar, wind, all those things. And I believe nuclear as well. I think that's more recent. We have Brookfield Infrastructure as well. That's utilities, electric transmissions, pipelines, data infrastructure. BN owns 27% of it. That's like data centers as well, AI data centers. We also have BBU, which is Brookfield Business Partners. That's private equity operate in industrial operations. BN holds a 68% combined interest in it. Then we also have Brookfield Reinsurance, which is their insurance platform, like I mentioned before in previous videos. And we have Brookfield Property Group, which is 100% owned, privately held, not publicly traded. And then we have the private portfolio, which is 78 billion. 60 billion invested in public holdings, 78 billion in private holdings. The private side includes mostly real estate, housing, logistics, hospitality, offices, retail, spread across multiple continents. So obviously very big, like Dom said, distressed European real estate or Brazilian distressed assets, things like that. As you could see, very vast. And the key insight for valuation purposes, BN is essentially the sum of its part. The net asset value discount thesis rests on the fact that the market values BN at a meaningful discount to the aggregate value of stakes in BAM, BEP. I'm not going to go through all the acronyms, or the tickers, but all the Brookfield subsidiaries, we'll just say, and private assets. BAM is the crown jewel, the capital light feed machine. BN's 73% stake is the single most valuable component of the net asset value. So overall, I really do love the company. The more I learn about it, it's certainly complicated to understand, but the more videos that we do, the more we understand the nuances of the company, and the more we understand Bruce Flatt, because he's the one really handling the ship. He's the one that's directing the investments and everything. So, Dom, is there anything you want to add? Any closing thoughts?
I would just say he's just definitely an interesting guy. I mean, definitely another unique investor with definitely a little bit of overlap as well, but does have his own niches that he carves out to make investing interesting from his point of view.
Yeah, exactly. All right. Thank you, Dom. I appreciate it. Thank you, everyone.
Thank you.